Let's move on to the next session, session one, and it gives me great pleasure to invite Dr. Peter Brewer, Division Chief of the IMF's Asian Pacific Department, to deliver his presentation, setting the scene for our next session, which is on the road to debt sustainability, how has Sri Lanka addressed its debt vulnerabilities. And I'm sure his insights will help us unpack the challenges, choices, and solutions that have shaped Sri Lanka's debt restructuring journey so far. Over to you.
Well, thanks so much. It's a pleasure to be here. This session is meant to sort of take a closer look at the debt restructuring and various aspects of it, and to get us going. I have this short presentation here, and then we'll have an excellent discussion. I should say it's based on a working paper that's forthcoming that I'm writing together with some colleagues who were on the team as well, deeply involved in the debt restructuring, Sandesh Dungana and Mike Lee. So watch this space for the paper. These are just briefly the four issues I'll touch on. Generally, how to return to sustainability, the domestic debt operation, the coordination issues around external debt restructuring, and then a look ahead. So looking at sustainability, in that area, the program really has, or had, maybe we can almost say, the dual objectives of restoring external sustainability as well as sovereign debt sustainability. So, as you know, Sri Lanka was almost out of usable reserves in April 2022. So a key objective is how to restore these reserves, build reserves back at the central bank, and at the same time find relief on the external debt service. So you can see here on the left-hand side of this chart, this chart basically shows you what the achievement of the debt restructuring along 4 or 5 different aspects of it. The leftmost one is foreign exchange debt service during the program period. That was reduced by $17 billion. That's a sizable number. It's a reduction by about 57% to help restore external sustainability. Sovereign debt sustainability is then restored through a combination of both debt relief as well as the policy adjustment that we've been talking about here early on in the morning, that of course isn't particularly popular, but part of the way of restoring sustainability, and that needs to be maintained even after the program is finished. So the debt restructuring helped deliver a reduction in gross financing needs and also of FX debt service after the program period by about half. So significant reduction in both. And then the debt stock. This is something that comes up often. Oh, debt is going to be so high even after the restructuring. Well, external debt actually falls significantly. It falls 27 percentage points of GDP, from about 69% pre-crisis of GDP to about 42% of GDP. Now, it is true that debt will remain relatively high. Much of that is on account of domestic debt, which, and we will get to that, during the restructuring there were concerns about how, what could be done about domestic debt. Now, is the debt sustainable? Well, yes. The way we looked at it, it's a complicated model that's sort of behind it, but essentially it is tailored to the specific purposes of each country. And in the case of Sri Lanka, there is a very high private savings stock. So you can see here on the left-hand side, the chart shows you in emerging market and middle income economies the degree of private savings, where Sri Lanka is the second highest. So this is something that has happened, following the end of the Civil War. Savings really were restored, and the government, of course, had a need for it. Much of that is intermediated through the banking system, so you can see that on the right-hand side. Sri Lanka's banking system is quite large when compared to other countries, and so there's no reason to believe that should change over time. Another aspect of determining debt sustainability is to look at how has debt evolved in the past in Sri Lanka. What volatility has been there. So on the left-hand side, you can see a chart called the so-called PAN chart, which is basically looking at the probabilities of how debt in Sri Lanka might evolve, taking into account Sri Lanka's own history. So it's a pretty wide chart, and accordingly, the debt targets had to be calibrated in such a way that one takes into account that there is a considerable probability that debt might increase. So this is something that was taken into account. And then the other important aspect in the assessment of debt sustainability is, of course, the macroeconomic framework on which the whole exercise is based. And the right-hand chart basically shows you how it was anchored relative to other debt restructuring cases. And unfortunately, on this screen, you can't see this kind of gray zone, which shows you the interquartile range. But essentially, the macroeconomic assumptions in Sri Lanka with respect to growth, in particular, were calibrated in such a way that Sri Lanka's case is no more and no less optimistic than the median of these other debt restructuring cases. So it's just around the median. So coming to the domestic debt operation, with domestic debt having been very large in Sri Lanka, around half or more than half, it's understandable that the authorities looked at whether domestic debt needed to be included in order to achieve the debt targets that had come out of the debt sustainability exercise that I was just talking about. Now, there, of course, was an important consideration with respect to the banking system. So they were heavily exposed to government debt, but banks didn't have large capital buffers that would be able to absorb losses from a potential debt restructuring. Banks were already hit by the crisis that was happening in Sri Lanka with many people losing their livelihoods, large inflation. I mean, you all know the macroeconomic imbalances that were happening, so banks were already hit by that. So a further hit from domestic debt restructuring could well have triggered a larger crisis. And fortunately, that didn't happen. But that was one of the trade-offs that the authorities needed to think about. Financial stability, they needed to think about market access eventually after the restructuring is completed. In fact, even though Sri Lanka was cut off from external markets after it declared a default, it never lost access to domestic markets. And then, of course, there were social stability concerns because one of the large holders in Sri Lanka, of course, was the EPF, which for many people is their sort of lifetime savings. And so a considerable hit to that could have caused social instability. So I think that is also an important lesson that can be drawn from Sri Lanka's debt restructuring for other cases, that one needs to be concerned not only about financial, but also about social stability. So because of these concerns, the authorities focused on maturity extensions and interest rate reductions as opposed to nominal haircuts to the principal of debt that was outstanding. And that helped to reduce debt service and the stock of debt. So you can see in the left-hand side of this chart, the domestic debt operation helped to reduce the average gross financing needs by about 1.2% of GDP during the program period and 1.7% after the program period, and the debt stock was reduced by 5 percentage points of GDP. And on the right-hand chart, you can see how after the domestic debt operation was completed, how sovereign risk came down. This chart shows you the difference between the 3-month Treasury bill rate and the policy rate. So it's basically an indication of sovereign risk as extracted from domestic markets. And so here I think there's also an important lesson from Sri Lanka for other countries. You can see how that spread shot up very rapidly in late 2022. So this is when there was a lot of uncertainty about what was going to happen with domestic debt. There were many rumors, there were many concerns that domestic debt could be restructured very severely, and people didn't know. And as a result, they, in order to continue holding domestic debt, asked for very high return, very high interest rate. So the government needed to pay that very high return, which worsened debt sustainability dynamics, of course. It did, of course, help the holders of this debt. So, the EPF, the banks, all the holders of this were suddenly earning much more interest than they thought that they would be earning, which then later on helped when they had to absorb some losses. But all I want to say is that for future cases, I think it's important to bear in mind the potential of what can happen if maybe communication isn't quite there to be very clear about what domestic debt, what is going to happen to domestic debt. So that's, I think, an important consideration. External debt restructuring. So there were many coordination challenges because Sri Lanka had a very diverse creditor base. You can see on the right-hand side a chart that decomposes external debt of Sri Lanka at the end of 2023. About half of that is that light blue part of the pie, which is the international sovereign bonds, held primarily by external creditors, but also in part by domestic banks who, of course, needed to be able to absorb losses from the restructuring of that part of debt. And then the other half of the pie is official debt, which again you can see is kind of broken up quite a bit. The red portion is what was ultimately represented by the official creditor committee. The sort of striped part is what was held by China Export-Import Bank. They're smaller slices. And then the green part is the China Development Bank, which actually was commercial debt. Sorry, I should have made that clear earlier. So very diverse creditor base, and that made it challenging for Sri Lanka to engage with all of its creditors at the same time. And I think we will hear a little bit more now in this panel about how to accomplish such a task, because ultimately the debt targets needed to be met in order to restore debt sustainability for the IMF to be able to continue to lend. And so it's quite a challenge to get everybody to come on board with this. So there were, as soon as staff level agreement was reached in 2022, September 1st, 2022, the Sri Lankan authorities went out on a journey to try and get everybody to come on the journey with them. There were many efforts to gather official creditors to get them to start talking. And it took a little while for these committees to then actually to be formed and for there to be a proper forum for discussion. In that, the authorities made important commitments of how they were going to deal with the debt restructuring, in particular transparency, that they were going to be sharing information, and also commitment to comparability of treatment. And I think these commitments were important to get creditors to come along on this journey. The external restructuring then did have a significant impact. You can see in this chart the blue bars were the external debt service before the restructuring, and the shaded green bars are post-restructuring. So a lot of the debt was shifted from the near term to the longer term way out to 2044. Significant interest reductions as well. $3 billion were forgiven altogether. And yes, there was a state contingent debt instrument introduced at the behest of the private bondholders, and the little bars that you see on top of the green bars are one that they show what debt service will be if in fact that state contingent feature is triggered. So it's there, but it's not huge. So it's important to keep that in mind. All this resulted in meaningful debt relief in net present value terms. I think it was around 41% at a discount rate of 9%. That would be slightly reduced to 37% if the state contingent feature is triggered. This profile just shows you, these sort of 5 different states of the state contingent instrument. But given the time, I'm going to skip over that and just go here to the sort of more forward-looking slide, which essentially says that you can see in the top chart how the sovereign spread in external markets has declined rapidly following the completion of the debt restructuring in December. And in fact, I think earlier there were questions about market access. We'll get to this in this panel as well. But the spread that Sri Lanka had immediately after the restructuring was certainly in levels that would be consistent with being able to issue debt, around 500 basis points or less, which is comparable or was comparable at the time with Pakistan, Nigeria, other countries that are issuing in markets. Of course, the trade tensions kind of upset that picture a little bit, but I think it has come down again. Just one point on the interest to revenue ratio. This is something that comes up quite often, that this is very high, and you can see here how around the debt restructuring it did in fact go up. But as a result of the restructuring, it will come down to essentially its pre-crisis levels. And in Sri Lanka, this has always been much higher than in other countries because Sri Lanka is a country that has relatively low revenue, which is, of course, it went so low that a crisis happened, but it has lived for many years with low revenue. So it's kind of a choice that society has made. It cannot raise the levels of revenues that you see in other countries. And as a result, the interest to revenue ratio always tends to be higher than elsewhere. So let me stop here and hand back to you. Thank you.
Thank you very much, Dr. Brewer, for that thought-provoking presentation, which laid a solid foundation for our next conversation. And as Dr. Brewer now takes on the role of moderator, I would like to warmly welcome our distinguished panelists to the stage, starting off with Mr. William Bruce, co-chairman of the Paris Club, Mr. Deshal Dimel, former economic advisor, Minister of Finance, Dr. Joanna Chua, head of emerging markets at Citibank, and Ms. Deborah Sandstra, partner in capital markets at Clifford Chance.
Okay, thanks very much. So I think we have the inside panel here. We have the people who know how the restructuring in Sri Lanka happened. We are very lucky. Deborah, of course, advised the authorities on the restructuring from the legal side. Deshal was the authorities' point man on the restructurings. He was in the room when the discussions happened. And of course, William was on the other side in some of those discussions with respect to the official creditors. And Joanna has a very, what shall I say, sort of distant view, because although she didn't represent creditors herself, she of course engages with them and looks at Sri Lanka's economy on a daily basis. And so I think we are going to get very valuable views here today. I thought I'd start with Deshal, who's been there involved in the restructuring from the beginning. But even before the beginning, before you got involved, before I got involved, the then authorities were very committed to continue servicing the debt, even when outsiders started to have doubts whether it is sustainable. So the IMF, for example, my predecessor came here in 2022 and they were discussing the sustainability of debt, and then eventually published an Article 4 staff report that said that the debt is no longer sustainable, which was, of course, a difficult moment. But I wonder whether you can sort of just elaborate a little bit about, what was the thinking at the time that essentially delayed confronting reality that it wasn't going to be working out, and what the cost of that was.
Thank you, Peter, and thank you to the IMF and the Central Bank for inviting me to speak this afternoon. So I think the fundamental issue, in my understanding, is that the authorities at the time appear to have mixed up Sri Lanka's economic concerns as though they misdiagnosed it as a liquidity issue as opposed to a fundamental solvency issue. So based on that misdiagnosis, the remedial steps were largely in terms of trying to bridge liquidity gaps by trying to find short-term credit lines from whoever would fund at that time. But the problem was that given the fact that we had a more deeper solvency issue with unsustainable debt, with deep fiscal, overall macroeconomic vulnerabilities, lenders were not really willing to provide that kind of funding to Sri Lanka, even on a short-term basis. And the reality was that even by the early 2020s, we had been locked out of capital markets. So we didn't have any financing inflows coming in. But as you said quite rightly, we continued to service our external debt obligations. So the reserves were dwindling quite rapidly during that period. My sense is that the authorities at the time felt that, look, the primary concern or the cause of this problem is the COVID-19 pandemic, and that if Sri Lanka is able to hold the fort until the pandemic is over, vaccinate aggressively, and that tourism would then be able to recover, and that would provide the funds that can address the deeper liquidity issues. And that was, I think, the expectation, and why the government at the time didn't really want to take head-on the deeper issues that were faced. And I think there was a aversion to. I think there was an understanding that, look, the IMF at the time had said that debt was unsustainable, but there was an aversion to tackling the reforms that would be associated with the debt restructuring. So that would entail the measures that we discussed this morning, significant tax reform, energy pricing reform, discontinuing monetary financing. All of those, there was an unwillingness to tackle. So the preferred option was to have this kind of holding pattern, bridge the liquidity deficit, and then hope that tourism comes back and addresses that once the pandemic was done. But we all know that that was not how things materialized. Come April 2022, reserves have effectively gone down to near zero levels in terms of usable reserves. And then the country was effectively forced, they had no other option but to declare a temporary moratorium on selected external debt. And then those same reforms had to be undertaken under very difficult circumstances. Now, if we had decided to change course early on, if we had decided to address those necessary but painful reforms a year earlier, 2 years earlier, we would have had a much better control over the sequencing of those, make them spread out, phased in a manner that is less painful to the people. We'd have stronger negotiating positions with creditors, with other counterparts. But the outcome of the delay in reforms was that we entered the reform process under a population that was already under severe stress. So you're adding the burden in terms of higher taxes, higher interest rates, higher costs of utilities on people who are already battered due to the crisis. So it was kind of the delay in those reforms resulted in the worst possible outcome. But on the flip side of that, if we didn't go to that level of depth of crisis, it's an open question as to whether that degree of depth of reform could have also been undertaken. Because in the past, Sri Lankan governments have tried to implement reforms of this nature, but they have typically been reversed or they've been done in a fairly piecemeal manner. But this time, the reforms were comprehensive, they were deep, and what we have seen in the last 3 years is that they have now started delivering the results.
Oh, thank you for that insight. Ex post, of course, we know it was costly to wait, but it's always easy to have hindsight. So Deborah, you came ex post, and you saw the task in front of you, that a considerable mountain of debt needed to be restructured, and that was held by so many different creditors. Because when people talk about the Sri Lanka debt restructuring, it's really at least 10 different processes, right? You have, on the official side, you have the creditors that got together in the OCC and China. You also have some miscellaneous smaller creditors. On the commercial side, you have the bondholders, you have the domestic holders of the external bond, you have the China Development Bank. You have, there were also sort of some domestic, well, there was the domestic debt, the central bank holdings, the foreign exchange domestic bonds, and then of course the regular domestic bonds. So very complicated landscape. How did you think about this when you arrived? How did you go about coordinating everybody to work towards reaching the debt sustainability targets?
Thank you, Peter. So I suppose the first thing we did was really to map out the creditor landscape, which is now, of course, very easy because we have your pie chart to describe it all. But at the time, that required quite a lot of work, and setting up data sites to collect all existing lending arrangements and information that was relevant to the process. And we worked very closely with officials in the External Resources Department who have, I have to say, a fantastic filing system that's all hard copies of documents, not just electronic database. So that was very, very useful to us. As you said, you made a really important point, I think, in your presentation, that we tried, there was a lot of uncertainty among creditors as to what was going to happen next. And so we decided to set some parameters to engage with everyone very early on in the process. So letters were written to some lenders, diplomatic channels were used to communicate to everyone that the government was going to be working on the basis of full transparency and also comparability of treatment. And I use that in the broader sense, not just how the Paris Club understands it. So we tried to get those messages across in the very beginning, and also explain to creditors that we needed some time to work with the authorities to map out the sequencing of events and of our work, because it wasn't just a coordination problem, also we had to think about sequencing. And the one thing that maybe hasn't come out so much in the discussion so far is that in the very early stages, what we really had to help Sri Lanka obtain were financing assurances from the official creditors. And so our initial focus was really to engage with official bilateral creditors to help secure their support at the IMF Executive Board once staff level agreement was reached, because that would really be the first step, even in the restructuring, to unlock our next parts of the sequence. So if you recall, at the time, there was post-COVID and the DSSI initiative, a major initiative called the Common Framework that the G20 and IMF and others led on. But Sri Lanka was not a common framework country. So Sri Lanka had to lay down its own path for creditor engagement. And yet there were processes and lines of communication and discussions going on at the level of the G20 that we were aware of, but we didn't quite know whether they would also frame our own work. So in the end, I think there were tentative steps to see how this would all evolve. There were channels used through the Foreign Affairs Ministry, through the IMF, different country executive offices, through the relationships that the Ministry of Finance has with its own creditors, including the External Resources Department that I mentioned. And so there were discussions had, and I remember we were at the IMF annual meetings, and we were trying to decide how to invite the official creditors to come, who would be sponsoring the invitation, what would be the purpose of the meeting, what would we be expecting of people who came to that meeting in terms of their country representations. I could take all day to describe the diplomatic and protocol issues around this, but let's say that Sri Lanka was very, very proactive in using every line of communication open. Very quickly, Japan, France, and India emerged as countries that were willing to sponsor these efforts, and then went on to co-chair the official creditor committee. IMF staff played a key role, including the Sri Lankan delegation at the IMF, to help us bring people together. And I should say also the Paris Club Secretariat, in their capacity as official creditor committee secretariat, as it became, played an absolute key role in supporting both the establishing of the official creditor committee and then the work we went on to do throughout that negotiation with the official creditor committee. So that was one set of stakeholders. Bondholders, in a way, was much easier because they created their own two committees. So we had one bondholder group formed by external bondholders, and then many of the banks in this room formed a committee for local bondholders. So that made our work much easier. They engaged financial and legal advisors. The one thing it's worth saying in relation to those engagements is that we have to, as advisors, be very mindful of price-sensitive information. And so there are, through these processes, engagement at the advisory level that really take things on. But there are key points in the negotiations where steering committees of those bondholder committees go restricted, as we call it, and we all act pursuant to NDAs and can share information that is more price-sensitive. But you can only expect bondholders to go restricted 2-3 times during a restructuring negotiation, so you have to make the most of those times. And then finally, Peter, you mentioned domestic debt restructuring. I think the authorities in Colombo here obviously had access that they could facilitate, both in terms of representative of the superannuation funds, local bondholders, and of course the central bank officials. So that coordination was a great deal easier. But I think we were very focused throughout the 2.5-3 years to really get that message across that officials, the central bank governor, ST ministers were ready to talk to creditors at any stage and give constant updates as to where the process had got to.
Thank you, Deborah, for this comprehensive answer. So you mentioned the official creditors. Of course, William, as the co-chair of the Paris Club, was a very important part of that. Deborah mentioned Sri Lanka wasn't eligible for the common framework. How did you deal with that challenge? And also, if you can maybe talk more generally, how did Sri Lanka differ from other cases that you have seen in the Paris Club's very long history in dealing with sovereign debt restructuring?
Thank you very much, Peter. And I would like to thank IMF and the Sri Lankan authorities for the invitation to be here and to attend this great panel discussion. Indeed, this challenge of coordination between official bilateral creditors is not new. It's exactly why we created in 1956 the Paris Club to foster coordination between official bilateral creditors. So coordination between countries which are also shareholders of the IMF, so we also attend the IMF board. So this is why we have a specific role to play. and it was created in the context of the Argentina debt restructuring. And progressively, we have learned how to work very closely with the IMF staff, and the role of the Paris Club Secretariat is key to have a deep understanding of the macro framework, the debt sustainability analysis. And what the Secretariat has to do is to create a common understanding between the different countries in order to have a consensual view regarding the financing assurances to be provided to IMF. It means that we agree on the magnitude of the debt treatment, and then we work on the details of the debt treatment, the new interest rate, the new duration, the reduction of the debt service during the IMF program period. So, of course, IMF gives us, through the IMF supported program, the main parameters, I could say the magnitude of the debt treatment, but we have a lot of work to do for the details. And what has changed is, of course, the creditor landscape. Paris Club has evolved. For example, we have Brazil as member, South Africa is a prospective member, but clearly you have important G20 creditors which are not members of the Paris Club, for example, China, India, Saudi Arabia, and some other. And so when there was the COVID crisis, we had to build very quickly a debt service suspension in order to provide a debt service relief, and then for countries facing solvency issue to provide a common framework, so a coordination platform between Paris Club creditors and the other G20 creditors. But at that moment, in 2020-21, the focus was on low-income countries. So the commitment from G20 leaders to go through debt restructuring with a common platform with the Paris Club, this commitment was only for low-income countries. So when Sri Lanka came, indeed there was no commitment in advance to create a unique creditor committee for official bilateral creditors. So what we did indeed we reached out to the different official bilateral creditors, and I would like to recognize the effort of Japan and India to create this ad hoc, in a way, common framework. We invited China to come, but it was the sovereign decision of China to work in parallel. So what was very specific is to create this committee together with India, and also to have a sort of light coordination, flexible coordination with China. What does it mean concretely? It means that the working paper produced by the Paris Club Secretariat were shared with China. It helped, I think, to converge and to have a debt treatment provided by China, China Exim Bank, very close to the debt treatment provided by the official creditor committee. So we provided almost in parallel the financing assurances. In a way, we had a sort of competition, who could be the first providing the financing assurances, who could be the first having an agreement on the main parameters of the debt treatment, and then the memorandum of understanding. But what is important is, I think, that we built on the experience of what has happened also in parallel. We have worked very closely with China and the other G20 creditors for Zambia, for Ghana, and now for Ethiopia. So I think it has created a place where we know each other. We know very well our Chinese Exim Bank colleagues. And I think together with the strong commitment of Sri Lanka regarding transparency, fair burden sharing, comparability of treatment, it has paved the way for not perhaps a smooth process, but as smooth as possible.
No, thanks very much for this oversight. And maybe this is also a good opportunity to just mention the Global Sovereign Debt Roundtable that the IMF has created in the meantime. And in fact, Gita is an important contributor to that. So that is a forum to organize and coordinate debt restructuring issues at a high level. And the fora that William just now mentioned are more with specific country cases. And I think the two running in parallel kind of reinforce each other. The country cases bring to the attention of the global sovereign debt roundtable issues that need to be kind of dealt with at a conceptual level, and then vice versa. The coordination at that level helps perhaps in some cases to move restructuring cases forward as well. So Joanna, you as a head of emerging markets looked at all of these debt restructuring issues from a distance, but you are well aware of how creditors think about a debt restructuring case, what matters to them when they are being asked to essentially participate in a restructuring and provide relief. What can you tell us about sort of what is their thinking in a case like that, and also, you know, what role does an economic reform program like it was taking place here in Sri Lanka, what role does that play in all?
Yeah, so thank you. First of all, thank you very much for inviting me, Central Bank and the IMF. I'm very happy to be here. Yeah, so maybe I've had a lot of discussions with investors around this period. Maybe just highlight 5 things that I think were very important for bondholders' perspective. I think we have to take a step back and first understand that a lot of bondholders, they want to maximize recovery value. And of course, part of maximizing recovery value, they want to provide sufficient relief to kind of set the sovereign in a sustainable path. But they might not have the same incentive of having a sustainable debt path in a medium-term basis with sufficient buffers. So I remember early around the time when we were thinking about, you know, after the debt suspension and there was an IMF program, and then the first IMF staff report came out, a lot of bondholders, investors latched onto the fact that the nominal GDP assumption in the IMF program was so low. And I think what was really surprising to a lot of investors was the fact that the rupee already blew up. Like, we had a crisis in 2022. The rupee blew up, like, I don't know, 8% depreciation. And then at the same time, even though you have the staff agreement with the IMF program, they were still forecasting ongoing another 10% and another 7% average every year. So it was kind of, it was seen, again, as I said, bondholders want to maximize recovery value on a medium-term basis. They kind of lashed that off as an opportunity to leverage an opportunity to, that's why they were negotiating a lot, these macro-linked bonds tied to the nominal GDP. And again, the initial rounds of what bondholders were presenting didn't quite meet kind of the DSA targets of the IMF, and so you had to have a lot of iterations. So that's why there's always a bit of a kind of cognizance of this kind of conflict of interest that you need to kind of balance as you're going through this negotiation. The second thing, obviously, is clearly the economic reform programs really, really matter to investors, right? Because if you want to get Sri Lanka on a sustainable path, well, you don't want the whole thing to be borne by debt relief. You want part of the sustainable path also being borne by the fiscal and the economic adjustment program from the sovereign. And so clearly we wanted to have a very credible path. And I remember when the first kind of reforms came out, people were even skeptical, like, oh, can Sri Lanka really deliver that big of a primary fiscal adjustment? And of course, we've been surprised on the positive side. So I definitely think a credible reform program is really important, especially on the fiscal, on the revenue, containing any of these SOE losses that could be a drain on fiscal. So that was really important. The third thing that was really important at that time is I think people were also very concerned about political stability and the ability for the political institutions to implement the reforms effectively. And I remember when we had that crisis, we had a change in leadership, right? I mean, Gotabaya resigned, then we had Ranil come in, and we had a lot of changes in the top, the top level government officials. But people were really worried still about how are they going to implement this if, these are the same, some of the lower level people were around when a lot of the bad decisions happened in the previous regime. So there was a lot of questions. This is why I think the IMF program was so critical. It couldn't come soon enough because investors really needed that kind of assurance that there was a reform backstop to make sure these reforms were going through. And I think investors were also very concerned that even as you're getting through the advanced process of the restructuring, you had an election going on in September. So beyond the economic reform, I think the kind of political consensus to implement these reforms are very, very important. The fourth thing is, obviously bondholders really cared about fairness. Everyone cared about fairness. So I remember very early on, because after that big, even after that big rupee depreciation and the crisis, domestic debt was still very large. So I think a lot of investors I think they wanted some burden sharing of the domestic debt. So this is part of the reason why you had to have something. Of course, you had to, foreign bondholders had to be educated on some of the trade-offs that need to happen. But clearly, I think people needed that assurance that there was a bit of burden sharing, so they would felt that it was a little bit more of a fair process. And obviously, that continued on in all the negotiation with the official bilateral creditors. And then last thing is obviously transparency in the system, making sure that no one was getting any kind of, we all knew exactly what the pool of the debt was, where all the liabilities were. And I remember at that time there was still a lot of confusion in trying to add up the numbers. So I think that transparency was very, very important for a lot of the creditors.
Thanks very much. I think that's very insightful and helps us understand how private creditors approach this question. And I think my observation is that, in a restructuring, all creditors are always, you made the point about fairness. So it's kind of like if you have a pie, people are always concerned about what portion of the pie they get. But of course, the size of the pie matters a lot as well. So sometimes you can get more even though your slice is smaller if the pie is big enough. And so that kind of brings me back to Deschal, to kind of how did the authorities think about making that pie as big as possible? What would be sort of the strategy of, we've talked about the process, but now we're kind of moving more towards strategy and sequencing of the restructuring. Can you just sort of, bring us into the room when you were thinking about, what that restructuring strategy you would pursue?
Yeah, so I think there were kind of three fairly broad, high-level strategic objectives in the restructuring process. The first was to ensure that the restructuring is done in an expedited manner. We didn't want a situation where it drags on for several years without an outcome because of the economic situation that we had, because we knew that it was essential to get the restructuring done, to get the credit ratings re-rated as early as possible in order to support the recovery and then to get growth back on track, which is really crucial to grow the size of the pie. So the first priority was expeditious restructuring process. The second was to ensure that all of the restructuring arrangements that we had with each of these multiple creditor groups would meet the sustainability analysis targets, because that is what is needed to restore sustainability, again, important in terms of delivering the longer-term outcomes. So second objective, ensure DSA targets are met. And the third kind of strategic objective was to ensure that there would be comparability of treatment between all of the different agreements. Now, sometimes these different objectives would be competing. You would have there'd be tension between them. Of course, then at the outset of the process, I think a couple of days after the IMF board approved the EFF program, the government made an open commitment to all creditors, outlining the commitments regarding transparency, fairness, equitable treatment, transparency, and so on. I think that was an important first step to support that coordination as well, because that coordination was crucial to achieve that first objective in terms of getting an expeditious process. In terms of how we went about it, so it became a fairly iterative process. So in order to ensure that the DSA and the COT objectives were met, our advisors would prepare initial indicative debt treatments to be shared with each of the different creditor groups, and then the creditors would come back with a counter proposal, and that counter proposal would then in turn need to be assessed internally for compliance with DSA and compatibility of treatment. If it doesn't work, it needs to then be revised, go back and forth. So that happened on multiple occasions. With the bondholders, for instance, the IMF staff played an important role in supporting some of those assessments informally to say that, okay, we think that this might work, this might not, and so on. So it was a fairly complex and at times a drawn-out process in that iterative assessment. In terms of how it turned out in practice, of course, with regard to, we wanted to, with the objective of having it expeditious, our intention was to have as simple debt treatments as possible. So we wanted to minimize any of the state contingent debt instruments. We wanted to have things as simple as possible so that you don't have these complex negotiations in terms of trying to assess the different agreements. So that was our initial preference. In terms of what happened in practice, in terms of the outcomes, so we all know, as Johanna mentioned as well, the bondholders were not comfortable with there was a irreconcilable difference, I would say, in terms of the the view on the macro framework, which underpins the overall debt treatment and the debt relief requirement. So they were not happy to do a simple vanilla instrument. They wanted to have some kind of instrument that is contingent on the macro part, specifically nominal GDP. And I think the main concern, as you rightly said, was on the FX trajectory. So Sri Lankan authorities were not comfortable with doing that initially, and it took probably about almost 10 months before there was the initial restricted discussions at the principal level, where there were discussions based on a STDI, because we had a very strong preference to have a more straightforward vanilla instrument. But then eventually, the outcome of that, we had an SCDI instrument, the now known as the macro-linked bonds, which does meet the required treatments on a probabilistic basis in terms of DSA and COT as assessed by the IMF and the OCC secretaries respectively. Secondly, in the strategic objective in terms of ensuring compatibility of treatment, I think that was largely met. There were again complexities in getting there, I think largely in relation to information sharing, because again you have a conflict between, for instance, some of the confidentiality clauses in the agreements, and then the ability to share information within those constraints as well. So that also was difficult to overcome, but I think with a lot of back and forth, a lot of trust building, that was achieved as well. So in the final analysis, all of the agreements that we had collectively were able to meet the DSA targets. They were able to meet the compatibility of treatment obligations. So our intentions were met in that sense. And also in terms of time, I think Sri Lanka's, even though it felt like a really long process in terms of global comparisons, it was relatively expeditious. We were able to get agreements in principle with the official creditors within about 8 months of the IMF program approval. And again, final commercial debt took a bit longer because of the complexity of the CDIs. But eventually, by end of December 2024, credit ratings were upgraded. And that overall process, I think, was really important in terms of being able to help the economy recover, interest rates to come down, inflation to reduce, all of that supportive, and growth eventually came up at 5% in 2024. So that story about the pie being enlarged was, I think, eventually achieved in spite of a fairly complex and difficult process in getting there.
Thanks very much. Super interesting. By the way, just to alert the audience, think about the questions that you have. We are sort of adapting on the go here since we are running behind schedule, so we will turn to you soon. But while you think about your questions, Deborah, if you could just briefly talk a little bit about what Deshal was just talking about the individual agreements. You work closely with the financial advisors also. How did you make sure that it would all fit in the target? No easy feat with these 10 separate processes.
Yeah, there was a lot of financial modeling, as you know. I think Deshal has covered, the most important points. But just to reiterate, with every set of creditors, we would create a debt treatment profile and share that with them and explain how that was DSA compliant. Obviously focusing on the 3 targets that you mentioned, Peter, the specific reductions in debt to GDP, FX debt service reduction, and gross financing needs reduction target. And we would actually show them in quite a lot of detail how these targets were met. The same work was done with the Paris Club comparability requirements, which I'm sure William will touch on in a moment. That still leaves a little bit of flexibility for people to express preferences. And so a lot of the negotiations were focused on adjustments that would still mean that the debt treatment was IMF compliant and compatible with the DSA and compatible with comparability of treatment, but took into account investors' specific requirements. And so, as Deshal has said, a lot of that focused around the macro-linked bond component in particular with bondholders, who took a more positive view on the improvement in Sri Lanka's economy than the IMF baseline. I think that work was really very, very novel. In other country cases, we've had GDP-linked warrants, which have not worked so well, either at the time or subsequently in the markets. And we were absolutely adamant that we did not want Sri Lanka to be pushed down that path. So the result was we created something which was requiring new work, if I can put it like that, at the IMF, at the Paris Club as well. So that delayed us maybe a little bit, I would say, a few weeks, a couple of months maybe, while people got busy with their models and tried to sort of upgrade them to be able to fit SCDI features in them. There was a lot of questions around whether having upside features would lead to clawback rights being requested at the level of official creditors and also actually just commercial lenders. CDB also had lots of questions on that. And I think the fact that we were able to build in a sort of downward adjustment feature helped us, and maybe William, you can comment on this as well, but to ensure that the instruments could be compatible with COT and really protected the country more than had been seen hitherto in the markets. We also built in a control variable, had a probabilistic sort of test reference point as well to help. It wasn't just an open-ended sort of improvement for bondholders. It was tied to the price of the bonds themselves. But it was all very novel. I think the IMF will be writing a lot about SCDIs in the coming sort of year or two to really draw lessons from this. And Joanna, I think you're probably going to comment about how the bonds are trading now, which will be interesting, I think, for people in the room.
Thanks, Deborah. Yeah, I can certainly testify to what you said. The creditors' thirst for this state contingent debt instrument meant that we had to come up with a whole new methodology that would be able to assess whether or not whatever design the parties were agreeing on would be consistent with the debt restructuring targets in a sort of probabilistic way. Because if you have a regular bond, you can tell, okay, that's the debt service, does it fit or does it not fit? When you have an option-like feature, probabilities get involved, it gets much more complex. So that added some complexity. But Joanna, since we're talking sort of about strategy and sequencing, in Sri Lanka, the commercial bondholders were very keen to go fast. So as soon as the program was approved in March 2023, a few weeks later, they were right there with a proposal to the authorities of how they would like to restructure the debt. Why was it important for them to go early? More generally, what are the considerations around sequencing in dealing with all this?
I mean, obviously, if I'm a bondholder, I want to maximize my recovery value. It's not in my interest to drag out the restructuring. So the fact that they got organized early is a good thing. And I said, I think what was stark in that initial agreement was the nominal GDP assumption. Kind of people saw this opportunity, right? It's important for bondholders to go early because, just as I said earlier, bondholders' incentives they have a different time horizon than a sovereign, right? They kind of want to maximize recovery value. They're not thinking kind of in the future cash flow because eventually they kind of want to profit out of it, or at least minimize their losses, right? So because of this conflict of interest, it's important they go early because there's going to be a lot of back and forth negotiation that's going to take time. So you might as well get the process started. And clearly there was a lot of things to discuss and deal with, both the structure of the MLB, the share of the MLB, and the haircut on the PDI, the consent fee. There was a lot of things that were going on. And I think the other thing that was, maybe it was also important for us to kind of rolling and started, you know, a lot of these Sri Lankan bonds were sitting on these in the Asian kind of credit funds. A lot of investors in Asia that hold these Sri Lanka bonds. And you know, Asia had not seen a sovereign default since Indonesia's standby loans in 2000 or 2001, I can't even remember. So we have a whole generation of analysts that were really not familiar. We actually had to ask the people who covered Ecuador and Argentina to teach us, like, understand how to understand. So you need, in order to get buy-in in the process, you needed to start early to get this kind of education going. And like I said, there was a lot of this back and forth negotiation to get to what was both DSA compliant and COT compliant. And that took a couple of processes. So in a way, it's good that it came in early. It may have been unfortunate that the nominal GDP assumption was too low because that kind of set us off on you kind of wanted to wait for a revision to the baseline to get an agreement coming. So if you had something more realistic earlier on, it could have happened a bit earlier. But in the end, it was good that it was happening simultaneously because they still had to eventually satisfy whatever the OCC terms were also. So, you know, it did happen as best as it could, and it's good that it didn't get any more delayed.
Okay, thanks so much. So I'm trying to get us to lunch by 1:30. So if you know, I'll have one more question to William, but then I'll turn to you to see what questions you might have, and then we can take it from there. William, so we just heard from Joanna about why commercial creditors consider it important to restructure their bonds early, right? They have a high cost of capital. They don't want this non-performing asset sitting there. For them to be able to restructure their debt, they know that the Paris Club requires comparability of treatment. In other words, official creditors ask that whatever agreement that the country has with commercial creditors is no better than what they agree with official creditors. But private creditors don't know what's being agreed with official creditors. So comparable to what is what they say. So does that mean that private creditors always have to come after an official debt restructuring, because only then is it known what they are aiming to be comparable with? And then related to that, you're also struggling with comparability of treatment across official creditors, not all of whom were in the official creditor committee. How do you deal with this concept in that setting as well? If you can talk a little bit about this.
Thank you. Indeed, it was a challenge. I think regarding sort of comparability of treatment towards China, vis-à-vis China, I think it was not a big issue because, as I said at the start, we exchange our working paper. So, in a way, we went to the same debt treatment in a natural way. So it was not a big issue. Of course, we wanted to have information. China wanted also to have information about what we do. But I think it was okay. Indeed, the main question is about sequencing with the private creditors. As you said, as official bilateral creditors are also at the IMF board, and we have this comparability of treatment clause, you could think the better thing is to have a sequencing approach. First, an agreement between Sri Lanka and the official bilateral creditors, and then Sri Lanka can negotiate with the comparability of treatment in mind in order to have from the other creditors, the private creditors, a debt treatment at least as favorable from the Sri Lanka point of view. But this sequencing approach, it takes too much time. And also in the case of Sri Lanka, the bondholders, they are very big in terms of debt compared also to the official bilateral creditors. So it is fair from the bondholders' point of view to be associated as early as possible. So what we did is to engage regularly with the bondholders, sometimes directly, sometimes through Sri Lanka, in order to understand what they want to do, to understand their concerns regarding the macro framework, how they want to deal with that, with a quite complicated debt treatment with macro-linked bonds, and how on our side we need to take that into account. So it means that what was important is to create this space for dialogue, direct dialogue between official bilateral creditors and bondholders, and it happened, and it helped. I think one lesson is that you don't have only official bilateral creditors and bondholders, but you have also commercial banks. And notably, in your chart, you showed the importance of China Development Bank. And I think it was probably a mistake we did not to engage as early as possible with China Development Bank, because we discussed with them afterwards, and they were not they told us we would have liked to be involved earlier, and I think it's a fair point. At the end, the sequencing versus parallel, etc., it has to be managed by Sri Lanka, by the debtor country. There is a strategy of negotiation, and we need to let the debtor country to manage this negotiation. But I think that having parallel tracks is very, very important. And finally, regarding state contingent debt instrument, indeed it has created an additional layer of complexity. For some countries, if I think about Suriname, it was obvious that there is an external trigger, a discovery of oil and new oil revenue not integrated in the central scenario of IMF, because it was not done yet. So it was obvious that both creditors, official creditors and private creditors, we need to have a sort of upside scenario. It was obvious. In the case of Sri Lanka, as it has been mentioned, it was not something external, it was just a disagreement on the macro assumption. As shareholders of the IMF, I think it's fair for us to stick to the macro framework of the IMF, but we had to deal with this complexity. We had an internal discussion. Do we have also on our side to design a state contingent debt instrument with an upside scenario? I think that we collectively took the decision to keep a simple debt treatment, and we had a quite difficult discussion about, is it possible to have an ex-ante assessment of the comparability of treatment? Because, of course, if the private creditors, the bondholders, they agree to increase their effort in case of a downside scenario, and they want an upside and a reduced effort. So if they propose a sort of symmetric debt treatment with upside and downside, on the official creditor side, it's not fair to come only if there is an upside, of course. So we decided that we designed, and together with the support of IMF, a way to assess the comparability of treatment from an ex-ante point of view. So first, we decided that we want comparability of treatment to be assured in the central scenario of IMF, because it is what will be discussed at the IMF board. Then we also looked at the weighted average impact of the upside and downside in order to be sure that ex-ante, on average, it is fair. And then we added a sort of political element. We told bondholders, be careful if your upside scenario is too optimistic, meaning that if this upside scenario is realized, you will do almost no effort, then we will have a political issue at home. Because ex post, it will be difficult to explain. So this is why we converged to something reasonable upside, reasonable downside, and no need for us to come back in the future if the upside scenario is triggered. We have only one clause saying that if something unexpected could happen, then we could come. But if we are talking about only upside and downside scenarios described in advance, and we assess the comparability of treatment ex ante with a weighted average approach, then it is okay. So I think it's easy to explain now, but it took us months to be all convinced about the fact that it makes sense from a political point of view. And my conclusion is that it demonstrates the capacity of different countries with different perspectives to work together. It demonstrates the capacity of multilateralism to find solutions.
Very nice. Thank you. So let me turn to the audience and see what questions there are. Mortasa.
My first question is to you, William. You said the Chinese are fairly aligned. They are the biggest creditor in the world. why are they reluctant to join the Paris Club? I mean, if you call it the Beijing Club, will they join? And the second question is to you, Deborah. It's about these collective action clauses. I think Sri Lanka had a mix of dual limb and single limb, and the Hamilton Reserve Bank was a single limb. Can you comment a little bit about the challenges of the single limb and dual limb and how the different creditors behaved, and what is your recommendation in future that countries should only issue a dual limb instruments?
On your question, why China has not joined the official creditor committee, I think it's, of course, China has to answer first, but my personal view is that it was a very, very political decision for China to agree on the common framework for debt treatment, so G20, Paris Club, common platform for low-income countries. And it has worked. We need to make progress on that, but it was a very high political commitment. In the case of middle-income countries, there was no political commitment in advance, and I think it would have been too difficult to have the Chinese leaders to agree on that, and I think also China didn't want to create a precedent because they want to keep some room of maneuver. If you are in the same creditor committee, of course, you share more information between the different partners within the creditor committee, and you are committed to implement the same type of debt treatment. And I think that China decided, and it's fair, they decided that they want to have a little more room of maneuver, even if, of course, you need some exchange of information. So it explains why, at this stage, in the case of Sri Lanka, and also for potential future cases for middle-income countries, we don't have this platform, but I think that the Sri Lanka experience has shown that we can be pragmatic, we can share working paper, we can have many meetings with China Exim Bank, and at the end, I think we provided almost the same debt treatment. So in a pragmatic manner, I think we found solutions.
Deborah?
Yeah, and just to say, you know, we spent a lot of time with Exim China and China Development Bank, and I do want to also say they were very helpful in the negotiations we had. On collective action clauses, Sri Lanka had a mixed landscape, as you mentioned, some single series collective action clauses and some aggregated collective action clauses. That's definitely not the way to go in the future, but I think you now have a state-of-the-art indenture. You have very strong terms and conditions in your bonds. Definitely, I would advise Sri Lanka only to issue instruments with aggregated collective action clauses, which would allow in any future amendment, waiver or restructuring process, although I'm sure we're avoiding that, to bring together all series of bonds into one collective voting process. It was one of the challenges we faced. The documentation was not entirely consistent, but that was also a result of the fact that bonds were issued over a period of time during which market innovations were published by industry bodies and so on to facilitate sovereign debt restructurings in the future. But I think now that that work is in the public domain, we should always issue with aggregated collective action clauses to give you the best possibilities. You didn't have mandatory exchange mechanisms either in some of the bonds, which we had to work around. But I think with the very good engagement from both bondholder committees and the fact that agreement in principle was reached, we had to decide whether to, really go for very intense exit consents or whether to just do a more consensus-built offer, and we chose the latter approach because that fitted better with the philosophy of the authorities' approach to the restructuring, and thankfully it worked very well. But as you say, there is a holdout, and that wouldn't have happened if we hadn't had one bond with just single series collective action clauses.
Okay, we have room for one more question. Dr. Asher.
My question is about the domestic debt restructure. When Joanna was speaking, she said, look, the bondholders saw an opportunity on the Forex trajectory, and they fought hard and they got that state contingent instrument put in, the macro-linked bond. When Deborah was speaking, she said there were two ad hoc groups and one represented the local banks. Now, the EPF holders didn't have any voice. They had absolutely nobody to speak on their behalf, and they were basically directed in a particular way. I, as the chair of the Committee on Public Finance, went through a long process. And as an opposition at the time, we had to agree to come to some sort of settlement because, like Deshal said, we didn't have time. We needed some solution. It was a time when Jatik Josh and Martin Guzman, all those guys were here, and the Debt Justice Collective had written to the IMF and was creating sort of trying to create a consensus among the political parties. Look, we have perhaps another solution, right? We didn't have to agree to what was happening. So my question is, given that state contingent instrument has been put in, and if we do better than what was originally expected in the baseline, they'll do better off. Like Peter, you said, it'll go from 41 to 37.5 or something like that, the net present value reduction. My question is it possible still, given what the president said, given what the deputy managing director said, that people really in this country, took the brunt of the adjustment? Would it be possible to introduce, even at a later date, something to the agreement with the EPF so that if the government or if the economy does well, better than expected, they could also benefit from that performance? Thank you.
Maybe Deshal is best placed.
Yeah, it's an interesting point of discussion. So I think the issue of trying to introduce an SCDI that is similar in kind of spirit and nature to an MLB would be the expectation that the MLB is of the foreign international bondholders that has both upside and downside scenarios, right? So that would entail that in case the economy fares worse than the baseline, there would have to be additional debt relief provided. And I don't think that's a position that anybody could expect EPF holders to accept. So I think in that sense, it would not be feasible to have a similar CDI for in an expo scenario for superannuation holders. I think in general, if you look at the way that the domestic debt operation was structured, it was done in a way of trying to balance the requirement of getting the debt relief to meet specifically the GFN target, because the external debt restructuring was possible to meet the debt stock and the FX flows target. GFN was what was problematic. And so you needed that domestic debt operation to achieve the GFN. Now, the contention was that the bulk of this was imposed on the superannuation funds. I would disagree with that framing, because if you look at the other domestic debt holders, for the bills, it was the central bank holdings was restructured. It was not feasible to restructure the bills held by the other financial market, because that was the only source of financing for the economy, for the government at that time. So it was not practical to do a restructuring of bills outside of the CBSL. On the bonds, about 40% of the bonds was held by the banking sector, about 40% by superannuation funds. Of the banking sector, around 80% of those bonds were held by the state banks. So, and the state banks, as you know, is already facing restructuring for their FCBU holdings, their SLDB holdings. They would face restructuring on their exposure to the state-owned enterprises. So they were already taking a large hit. and they would already require material level of funds for recapitalization. So to do a restructuring on the bonds as well would have been required a significant amount of taxpayer-funded recapitalization. So that again was not feasible. For the superannuation funds, the restructuring was done in a way which have a minimum adverse impact because of the socially important nature of these holders. So there was no reduction in terms of the capital. The bulk of the effort came from the maturity extension, and the coupon was capped in line with the expected interest rate path. And if you look at how things have panned out, so the EPF holder, the superannuation bondholders get a coupon of around 12% until the middle of next year. Today, a 5-year bond is trading at 9.5%. So all of those maturing the maturing bonds pre-restructuring would have actually been quite worse off as opposed to the post-restructured rate. So I think it would be difficult also to convince the other parties who have gone through a restructuring that there is a need to impose an SCDI over and above the issue of the requirement of both an upside and a downside scenario.
Well, thank you very much. We are running quite behind, but I think this panel has been really interesting. There are many, many rich lessons to be extracted, in particular from the Sri Lanka debt restructuring. Domestic debt, we just talked about, concerns about not only financial but also social stability. There are creditor coordination issues where I think the bottom line is good communication is really what is needed in order to address the fairness issue that many are concerned about. Are they getting the same as everybody else? So keeping them in the loop, making sure that they understand what is happening, having a platform, having a forum where all this information can be shared. All these things are very important. Communication also mattering for, remember this chart of the domestic interest cost because of the uncertainty, how much of my domestic debt holding is going to be restructured.